Hi everybody, this is Thomas from Wynn Capital with the 2024 first quarter market summary. On the screen is all my contact info. Connect anytime if you have questions or comments. Before we get into the summary, let's take a quick look at the one-year chart for the S&P 500 ETF. So on your screen now is the 2023 from the left of this line, and 2024 first quarter here and the second quarter there. So if we use our little computer here, starting from the beginning of the year, the quarter that we're looking at had equities rising about 8%. Eventually, in the second quarter, here was the high on April 1st. Equities up about 10%. We had a 5% decline to be up 5% or 4% for the year so far, and another rally. And today, on the 30th of April, we're up about 5.62% on equities. Here's a breakdown on how the market, bonds, and real estate did for the first quarter, with the U.S. stocks, foreign stocks, and emerging markets all up, real estate and bonds down. And interest rates rose during the quarter, so bonds fell, and higher interest rates hurt real estate as well. Looking out over a longer period instead of just one quarter, looking at 1 year, 5 years, and 10-year periods, we can see that everything was up for all those periods. All equities, real estate, and the bond market have been in a strong pattern, so the 1 year, 5 year, and 10-year are all up. On the screen now is a chart of how the market performed during the first quarter, from the beginning of the year until the end of the quarter, and the news that came out during the same time. The market, knowing that the Fed had talked about stopping rate cuts and maybe even lowering rates, rallied to new highs. At the end of the quarter, the market set a record, which has kept being set this year. There have been many new highs set this year, for all-time new highs in the U.S. and global markets. Looking at a longer period of time, over the 12-month period, tons of news back last year in March, and I've highlighted some of the news that affected the market. This is a breakdown of U.S. stocks, and small and value were trailing versus large growth stocks. The big tech stocks that we all know have been on fire for pretty much all of this rally from COVID through today, and they continue to act very strong. The pattern is the same for the international developed stocks, with small companies making good gains, but large and growth doing much, much better. And just as with the U.S., there's been the 1 year, 3 or 5, and 10 years are all positive due to the very, very large rally we had after COVID. If we look at emerging markets, the record's still the same. Emerging markets is the most volatile. They have the highest returns over time, over long periods of time, because they're risky, but they still have negative returns over the 3-year period. They got hit really, really hard during COVID and haven't recovered all the way, although the shorter term and longer term are positive. Country returns, is always a wide gap between the country with the highest returns and the countries with the lowest returns. The average return is this dark bar, and the U.S. was a little bit above average with pretty strong equity returns. Now we're taking a look at the commodities, and again, a very wide spread between things that are up and things that are down. In general, energy is up and food commodities are down. There was one outlier with natural gas down the largest. Even the most everything else in the energy complex was up. I've highlighted over here that over the 10-year period, this whole list of commodities has been going down. That's disinflationary, and at various points it has been extreme, maybe even a huge decline on an annualized basis. But we've had inflation lately due to many factors during COVID, and we've got inflation and higher prices across all these commodities. Now we're looking at a chart of fixed income, where there's lots of different bonds here, the 10-year Treasury, different state bonds, and corporate bonds over here. And this, for the quarter, short-term rates were positive because they're unaffected by rising interest rates. For the quarter, interest rates rose, and longer bonds, like the U.S. government long bond, fell. And let's take a little look at a chart of interest rates versus bonds. On the screen now is TLT, which is a 20-year Treasury bond fund. It's an ETF that owns a basket of long-term bonds for the U.S. government, and the average duration is 20 years. So it pays an interest rate of around 4%. So that comes every year. If you're holding this, you're going to make about 4% interest. But this is the capital gain and loss, and it is an inverse of interest rates. So if TLT is falling, it means that rates are rising. If TLT is rising, it means that rates are falling. Now I have on the screen interest rates. This is interest rates on the 20-year bond. So interest rates right now are about 4.7. You just move the decimal one place. They move it to the right just to make the graph look a little bit better. But we saw the exact opposite. So rates rose. Right around here, the government said that they might start lowering rates in March of this year. And before the Fed ever did anything, interest rates fell quite a bit, and the bond rose. Ever since then, statistics have come in, and it's caused interest rates to rise. So our bonds, we bought a bunch of long bonds around this area. They went up. Now they're going down this year, so we have negative returns in bonds at the moment. So now I've combined the two charts. The bluish lines are the TLT, and the candlestick charts are interest rates, and you can see they just go in lockstep. Inversely correlated is what we talk about. So here, as we go up in interest rates, we have down, and and the added thing is that if you take the duration of 20 years and times interest rates, a 1% move will cause this TLT to go up or down 20%. Interest rates times duration equals capital gain or loss. And finally, we've got some research from Dimensional Fund Advisors, basically telling the story of how BlackBerry was once one of the fastest growing and highest performing stocks of all time for a moment in time. And we have a period now where there are very many tech stocks that have had unusually high returns for a long period of time. It's attempting to tell the story that diversification is a safer way to get where you want to go. It's possible to get there, but you take the risk of having concentrated positions, of having something go wrong with that particular company that you don't have when you own a large diversified portfolio. So I hope you enjoy that. That is it for now. And if you have any questions or comments, you can get in touch with me anytime. And I'll see you soon. Bye-bye.